Welcome back, asset builders. You are listening to Happy Homes Portfolio Power Ups, the show that gives you the blueprint for profitable real estate. Last week, we tackled screening. Today, we are tackling the single biggest number that will kill your cash flow: maintenance. A poor budget estimate can turn a great deal into a money pit overnight. That's why we always tell our owners, stop fixing, start investing. And to truly invest, you need to budget for the things that you can see. Today, I brought in the man who keeps our assets running smoothly, our maintenance coordinator, Bill. Bill, thank you for coming on the show.
Thank you for having me.
You are the expert who sees the real world cost data. What's the biggest mistake a new investor can make when budgeting for repairs?
The biggest mistake, hands down, is ignoring the capital expenditure, or CapEx. New investors look at the 1% rule and they think that it covers everything, but it doesn't. A broken faucet is maintenance. A broken water heater, 20 years old, is CapEx. If you haven't reserved that money for the water heater, your cash flow will be dead for the month.
That's a perfect lead-in. We need a foundation. Bill, what are the quick rules of thumb investors can use to get a starting baseline before they buy a property?
There are three common ones, and they're good starting points, but that is all they are, starting points. The 1% rule, which we've already discussed, budget 1% of the property's purchase price annually. So a $300,000 house means that you're going to set aside $3,000 every year. The square footage rule, budget $1 for every square foot annually in the home. A 1,500 square foot house means $1,500 a year. The 50% rule, set aside 50% of the gross rent for all non-mortgage operating costs, taxes, insurance, and maintenance.
So if I'm looking at a 1,500 square foot home worth $300,000, that's $1,500 or $3,000. That's a big difference. How can we narrow this down? It seems like age is the most critical factor.
It absolutely is. Those generic rules of thumb don't account for the life cycle of a roof or an HVAC unit or 70-year-old plumbing. That's where we move from a general budget to the age tax.
The age tax. I love that phrase. When we do our professional underwriting, we don't use 1%. We use a percentage of the gross rent, and that percentage goes up dramatically with age. Can you walk us through these tiers and explain why the budget doubles or triples as properties are older?
I can. We group properties into three buckets. This is based on real-world cost data. For new homes under 5 years, we budget around 2 to 3% of that gross monthly rent. These costs are almost all routine: light bulb replacement, filter changes, a bit of wear and tear during turnover. Low CapEx risk. The middle tier is 5 to 20 years. This is the danger zone. We budget 5 to 7% of gross monthly rent. Why? Because the original appliances, the dishwasher, the water heater, and the HVAC compressor are all starting to fail. These are expensive, unexpected replacements. And then you have older homes, 20 plus years. This is where you pay the tax. We budget 8 to 10% of the gross monthly rent and often higher. You're budgeting for guaranteed replacements of major systems: the roof, the HVAC system, and plumbing.
That context is gold for investors. It's the difference between thinking you have a profitable investment and facing a $15,000 emergency expense you did not plan for. So an investor is walking through the property right now, pre-purchase. They know they need to adjust the budget up. Bill, what are the top 3 things they should look at, or as their inspector, that would determine if they need to budget up or down?
Absolutely. 3 non-negotiables that will swing your budget thousands of dollars: the HVAC system and the water heater age. Look for the metal sticker with the serial number on it. If that tag says the unit is over 10 years old, you must budget for a full replacement right now. Even if it's working, its useful life is almost over. Then you have roof and siding condition. Look for curled or missing shingles or signs of water staining in the attic. A roof is $10,000 to $20,000, CapEx event. Look at gutters and downspouts. If they're clogged or damaged, water is already impacting the foundation. And then you have the plumbing system. If the house was built before 1980 and the owner can't provide paperwork showing it's been replumbed, assume it has galvanized or cast iron pipes. Those are massive CapEx events waiting to happen. They leak, they back up, and they're expensive to replace.
If you hear original plumbing, That 8% budget just jumped to 12% for the next few years, and that is crucial advice. Bill, thank you for putting real numbers to this equation. It shows that managing the nuts and bolts of the true foundation for growth. To our listeners, remember, budgeting accurately for maintenance is where passive income becomes truly passive. Getting professional help to track those life cycles and execute those repairs efficiently means that automation isn't a luxury, it's your profit margin. Bill, where can listeners learn more about how Happy Homes handles these maintenance issues?
They can find everything, including a link to our detailed CapEx planning checklist on the Happy Homes website at www.happyhomespm.com.
Excellent. Thank you again, Bill. And thank you for tuning in. If this episode helped you save money for your next purchase, please subscribe and leave us a review. Join us next week as we dive into winter preparedness and seasonal liabilities with our property manager, Megan. Until then, keep building that empire.